Thursday. It's almost Weenie, Paul. Your favorite.
Don't call it a holiday.
Is it? Don't call it a comeback. We are here live in we're in Ridgefield, Ohio, but Paul and I love to call it Akron because we are Akron homeboys, right? I moved home, so I just came out of really wound up, over busy Columbus, and I came out to the countryside to join you because I love you, and here I am hosting this incredible show. Now, Paul, we have been ramping up our subscribers. I can't believe it. Every day you and I check in on these subscribers. It's incredible. You love it. I love it. Did you see the most recent? Today's episode is brought to you by
Snickers.
The taste that satisfies. What's the slogan? Anybody know? The Snickers. Paul, you don't look like you when you are hungry. Is that the?
Huh?
Oh, that's the Snickers commercials.
Yeah.
All right, guys. Thanks everyone for joining us. We have so many people watching already. This is incredible.
I need Seth to take it down.
I am fired up. I am ramped up, and we are
slow
ready
down.
to go. Paul, go ahead, Paul.
I got a complaint the other day. Somebody said you went too fast on the Etsy video, and I said, remember I said you afterwards. I'm like, why were you flying for that thing?
So let me bring it down to you, folks. Bring in the Barry White voice. Paul said one day that if I learn too much on this show, the show will go south because
I did not say that, but yes,
we need
you to be dumb.
We need a sort of someone who is on the less intelligence level when it comes to this subject, Paul.
Okay.
Like our viewers that you might very well be. So I'm going to pull this very low, sort of bassy voice back in.
Bring it way down. Your wife
Bring it
just
way
said.
down to a New Orleans, a little bit of an accent. And we are going to, we're going to talk about tech companies today. And first and foremost, Paul, you wanted to make some comments on the market, which I'd love to hear.
All right, guys. So in the last few days, the market's been down a lot. And we have a new viewer who is upset, who's like, oh no, the market's down or whatever he or she said.
Okay, who is this?
Rambo, was it? Not Rambo. I'm probably saying it wrong.
That's okay. Welcome all of the folks that are coming in. I see you, Dom.
Rambler.
Llewellyn, the man from Llewellyn. You're from the Netherlands, I think, right? Welcome in. And of course, my son, Paul, before you get into that.
And Beth's on too.
My 10-year-old son, he monitors our pillars, the 8 pillars per stock. He writes them down. He gets his checks going. And I imagine he's going to be very thankful to his Uncle Paul in the years to come. And you can too. So before Paul gets going, make sure you are smashing that thumbs up, guys. I can't believe we're literally 2 minutes in, 18 likes already. Again, we treat these as 1.8 million likes in our hearts. So you don't have to pay us a nickel for all this info. Just smash that like. Paul, go ahead and give me your thoughts on the market.
What I'm trying to teach here, one of the main things I'm trying to teach here is basically about value investing. It took me years to brainwash myself into understanding that lower stock prices are better. It seems counterintuitive, but it's true. I want you guys, big takeaway to take from us is that when you determine the intrinsic value of a business, when you determine what a business is worth to you, you should want the stock to go lower and lower and lower so you can buy more and more shares. And over time, the market, as it goes higher and the stock goes higher, it'll go closer to your intrinsic value. You'll make a lot of money. It's the only thing in the world, I always say, investments are the only thing in the world that people want to pay more money for.
Now, you say this to me all the time, and it really rings true, Paul. As other people join in, Brody, I see a Carpe TM, our beautiful gal from Hawaii. Welcome. This brainwashing, Paul, you have to be so disciplined, and I hate it because I call you and we hear news articles like when to buy. Like I was so ready for this last crash, Paul. I had everything in cash, folks. I sold all my stock. I had 100.
Which I don't recommend.
With 100 and some odd thousand. No.
Way more than that.
150, 60,000 in just straight cash homie, and I still was somewhat too hesitant, scared during the COVID crash to buy anything.
Yep.
And so, like, where did you develop? I'm guessing this.
It's a brainwashing. It was really an internal from reading and reading over and over what the best investors did. It's not going to happen overnight, guys, and it might not be for you. That's why we're bringing Trader Mo, who, by the way, Trader Mo is with my brother right now, so he's going to try to come on shortly. That's why we're starting to talk more about trading and momentum, because maybe value investing isn't for you. It's one of those things where it just hits with you or it doesn't. It hit with me very quickly because I think I always had it in me. But from a perspective of evaluating stocks, evaluating businesses, you want to buy the businesses as the price goes lower. That is just a fact. Is it hard to? Absolutely. Because even for me, when I buy a stock and it goes lower, CCL, Carnival Cruise Line, keeps going lower. Nordstrom keeps going lower on me.
Yes, you love Nordstrom.
And so what do? I sit there and go, am I wrong? And I go back and I evaluate it and say, I don't think I'm wrong. Could I be wrong? Absolutely. I kept adding to my S&P 500 short. As it goes up, I'm losing money. So technically, technically it's going down on me in that sense. And do I think about it and go, maybe I'm just wrong? Absolutely. But you take those situations and you go reevaluate all the things you did. You look at the 8 pillars, you go do more research and say, okay, if I reevaluate this, where do I stand? If you believe it still, and you take it from a completely unbiased standpoint, go listen to people who disagree with you. I go on to Seeking Alpha and I read the comments, or I read the articles that go against what I believe. So I'll sit there and say, hey, if I think JWN's a good buy, I'll look for people who are saying it's not a good buy and see their reasons. If their reasons are, it's retail, it sucks, I ignore that. But if they have a thorough reason, I'm like, okay, that makes sense. And then I go back and I read my analysis. That's what investing is all about. And the great thing about investing is your job is to do this with 20 or 30 stocks. You'll be wrong on several of them. You'll be really, really right on several of them. And the ones in the middle will be a hodgepodge, and you're supposed to do better over time because of that.
I think you've indicated to me too, is when you find the right companies and there is a huge downturn, typically those might not lose as much. You know, I invest according to Joel Greenblatt, the little book that beats the market. And so you've sort of coached me into thinking that when we pick those top tier companies, when there is a crash, I'm not going to lose as much.
Value investing does better during bad times than during good times.
And remind our folks watching again, like how really those flashy high-end stocks, they take the first hit, right?
The ones that drive the market up the most, the first ones to take the hit when they fall. Is that all the time? Maybe, maybe not. Remember, I was wrong on Amazon years ago. Mm-hmm. I shorted Amazon at 300 and got out of it at like almost 1,000. When I shorted at 300, I thought it was worth $50 to $70 a share. I currently think Amazon's worth between 500 and 800 a share. So I was completely wrong on Amazon. The market just carried itself through. I was wrong. Okay, move on.
David S. Pumpkins says, don't chew with your mouth open, of course, Paul. And then Caesar wants to look at NEO. We have done that before, NEO. I'm going to tell you now, it's not good. In terms of growth potential,
I think I just stopped immediately within the first,
yeah, NEO is very flashy, but Paul is really not here to go after those flashy stocks that everyone else is sort of screaming about. So with that said, Paul,
whose laptop is this? Nate, is this your laptop?
Yeah. So
I love the vans. I was like, vans are epic.
So Don's on vacation. We have our intern Nate in helping us. Oh, Nate, are you there? Are you there, Nate? Can I hear you?
I'm right here.
Yeah, Nate's going to be chiming in with some if we have guys have any questions, or if we find in the financials something happened in the past, Nate's going to help us look that up. So he's here. And this is his laptop. And of course, as a college kid, look at all those stickers.
So today we're going to focus on tech stocks today, right? Mm-hmm. Bigger tech stocks. Let's start with Cisco. How do you feel about that?
I like Cisco. What do they do again? They do like the systems,
hardware, software, supply, right. Networking solutions.
Cisco, go.
So I want everybody to look at the chart here real quick. Look at 2000. Cisco hit $80 a share in 2000. This is a company that was going to go to the moon. Mm-hmm. Look at this chart, guys. Look at this chart to 2000. What's going on here? It's parabolic. Guys, that was 2000. The highest it's been since is maybe $55 or $60 a share. That is 20 years later. This is what I mean when I talk about booms and busts. This company drove NASDAQ up, and when it came down to what? And this might have been $7 or $8. That's a 90% drop, guys, but it was fundamentally a good company, so it stuck around. That's what we want to find. We want to find fundamentally good companies. Keep in mind, guys, Cisco's paying a 4% dividend. That is awesome. But if you want to buy the company in full, this is the price we care about.
Market cap,
$150 billion. The current PE ratio, 13.6. Check mark.
You got to love that, Paul, right?
Good start. Very good start.
We want that under 20, and remind the viewers why again.
We want a PE that's the price you pay for all the earnings to be under 20. The historical average is 15 or 16, but we're willing to pay for a little bit more for good quality companies.
Jeff, we will do Intel today as well, but I will remind our viewers.
I've been buying Intel, by the way.
We're going to get right to that, Paul, so stay
tuned. Next one we'll do is Intel, and I'll explain everything I'm doing with Intel.
I'm reminding viewers, and Paul's discretion, we're going to slow this down a smedge and not do the speed round.
We're not going to do 20 stocks in one session, correct?
We're just going to slow down and learn, because again, we're not, Paul, wouldn't you say we're not here to find the best stocks? We're here to kick out the worst ones and get our 20 great ones out of thousands.
And per request of our viewers on our comments, I want people to understand more in depth of my process. So we're going to take a step back and start doing more thorough analysis about what we're looking at. And I want to engage the people in the chat to sit there and see what questions they have and also to answer some questions for me. So
go ahead, Paul.
Our first check here. Look at this profit margin, 21% last quarter, and it's about there for the year. So check mark there.
This is pillar number 2. Paul wants profit margin over 10%.
Yep. And their gross margin, 63%. That means for every extra dollar they make in revenue, they're going to put 63 cents of that to the bottom line. That's really good.
Okay, let's do revenue growth over the past 5 years.
Okay, I'm expecting this one not to be very great, but it probably still has growth.
Now, Matt is saying that you did wear jeans.
I did.
And a sweater.
It's a very chilly day in Ohio today.
No, Matt is saying this is a super serious episode and that you're really getting after it. Wait, Paul, will you move that stand closer to you so you can get in camera here?
Oh, I'm sorry.
All right, Paul, keep going. Let's go to pillar number 3, which is revenue growth. What do you think about revenue growth? What
did Gio say about not like the cars?
I don't know what Gio's saying. My 10-year-old son is on. Love you, Gio.
Okay. So 49.25 to 49.3.
Oh, listen, hold on, Paul. You're not going to believe this. My 10-year-old said that the profit margin for this company is 24, not like the cars from on Tuesday, that the profit margin, look at this guy.
Give Gio a job.
Wow, Gio, the 10-year-old, he's been around for 120 months.
Great job, Gio.
120 months, and he's remembering the profit margin on some of those crap car companies.
Gio might be our future value investor. So this is slightly a plus, but as you guys can see, it went from 49.25 down to 48, 49.3, 52, 49.3. So it is a check mark, not the greatest. Go back to the previous 5 years, 43 to 49, so they had good growth there.
How about profit margin? I'm sorry.
So then profit margin, guys.
Profit growth, Paul, pillar number 4.
Profit growth, 10.74, 9.6, broke even, 11.6, 11.2, check mark. Again, very consistent profit. There was clearly some big write-off here in 2018. We won't worry about that right now, but there is a check mark for profit growth. So far, we have all check marks.
Nathan, when you look up Cisco in 2018, or what year was that, Paul? 2018?
2018, the end, it would have been before July of 2018 and before and after June of 2017.
Something happened with Cisco. Okay, here we go. Paul,
so shares outstanding.
Number 5 is shares outstanding. We want that going down.
Check mark. Oh my God, we are check mark city here.
Wow, okay. How about pillar number 6, which is current assets?
I guarantee this is a check mark. I shouldn't say guarantee, but
over current liabilities.
I'm pretty confident this is a check mark. So current assets, 43.6 billion. Current liabilities, 25 billion. And they only have 57 billion in total liabilities. The cash on hand doesn't overcome it, but it's very close. So this is a very big check mark here.
So going back, Paul, does this, when we have excess cash on hand, is this going to affect our market cap?
No, because we only do that if the excess cash on hand is above total liabilities.
Okay.
This is only current liabilities. And this is basically cash on hand paying all debts on hand. Okay. So now for my favorite one, the cash flow growth.
Free cash flow growth is pillar number 7.
We're going back to annual. Free cash flow, guys, is cash from operations less capital expenditures. It's what the companies use to pay dividends, to make acquisitions without issuing more shares, et cetera. It's really what I want to look at to put more money in your pocket.
Okay, go ahead.
Okay, we have 12.4. We have 12.9. We have 12.8. We have 14.9. We have 14.7. Check mark there. Jesus H. Christ, guys. By the way, I want to make note. I've now made 2 errors that viewers have seen and caught. That's why you have to go do your own homework. Somebody messaged me about Peugeot. I was very wrong on that one about my calculation. And then a while back, I was looking at the wrong line. So it's just proof. You have to watch what you're looking at. We have to watch me still because we do this so fast.
This is 67.
Divided by 5 equals 13.4.
Yep, 5.4. You're good. 13.5.
Okay.
Yeah.
Times 20 equals 268 billion. So guys, what I did here is I took the average of the last 5 years of free cash flow, multiplied by 20. And the reason I do 20, it's just to start somewhere.
Mm-hmm.
To look at every company differently based on, this is a very high free cash flow business with very low capital expenditures. So you might want to pay a premium for it. It's also a well-established business. So maybe somewhere in the 15 to 20 range is probably accurate. So it's probably somewhere in the 200 to 268 billion dollar mark. And guess what, guys? What was our market cap?
150.
150. So what is this for me? A massive check mark. Guys, I think we had check marks on every single category.
Hold on a minute. What did you just find? Your times 20 was well over 150, I thought, Paul.
Exactly. That's what I'm saying. Major check mark here. It was 260.
The market cap is well under what you think it should be.
Yes, correct.
Oh my God, Gio, write this down. We're buying Cisco. Paul, what would? I'm baffled. I'm baffled.
Now, when I do an analysis of Cisco in this sheet that I made, I think you're going to do fine buying Cisco. It's going to pay you a 4% dividend.
That's great.
Yeah, great dividend. It can afford the dividend.
Because it has free cash flow.
It has, because right now the dividend pays about $6 billion out of its cash every year, and they were generating an average of $13 billion. So it's not even taking up half their free cash flow. I like this company. It's not going to grow a ton. Keep that in mind, but you're going to get your growth by getting a dividend and getting a secure company that's hopefully going to keep increasing their profit, or at least keeping the same and going forward.
I think, Paul, this has not happened often where we get check marks across the board.
Yep.
It's not overpriced in terms of market cap or PE. This is an incredible find.
We need to get closer. By the way,
so two things. Jean-Marie, I see the board has been acting up. It's a Samsung board. It's been acting up today. So we don't have the cut to it, but Paul's going to increase our percentage on the board and make the numbers bigger right now.
Yep, I'll
so
do
that
that.
You guys can see it. So, and our gal Carpe Diem in Hawaii says she owns Cisco and Intel. So great moves for you. As always, make sure you are smashing, destroying that like button. That thumbs up. We're doing great tonight, guys. And Paul, there's 54 people watching. It's incredible. These are our dreams have come true. We can just
that's better, isn't it?
Yeah, a little bit bigger. So yeah, Paul made the board a smidge bigger, guys. So yep, here we go. Make sure you're smashing it like Paul. Your final thoughts on Cisco? I mean,
Mo and I have talked about Cisco before. We've liked it, and there's no problem with it. We're just going to do a little more research, but it's definitely on our list of companies to buy.
Paul and I will, seeing that we had a bunch of checks, maybe Paul will do a Cisco only video on this after you do a little more research on this. A lot of people are asking for your final thoughts in terms of more research on these companies. And Caesar's asking, what's a good entry point for Cisco now?
So guys, the interesting thing is this. So great question, Caesar. But one thing you got to remember is, as a value investor, you don't care what the entry point is. What you care about is, am I buying it at a good price? I would not put, if you want to put $10,000 into Cisco, I wouldn't put all that $10,000 into Cisco right now. What I would do is I would sit there and I would determine what it's worth, and for the next few months, put $2,000 in every month or every 2 months and dollar cost average in. Especially where the market is, it's hard to go put all your money into something at once. Kind of even do a thing. Well, you can't really do the puts, but
why don't you look at the momentum and show people where we're headed for this company?
Well, okay, sounds good. A good idea.
Okay.
Momentum, which we didn't look at before. So right now, guys, the actual momentum is actually negative here. The 50-day average has gone below the 200-day average, and it's widening. So there might be opportunity to buy Cisco at much lower prices here in the future. As you can tell, early February, it got as high as $50. Now it's at 35. So just keep that in mind.
Tell me this, Paul. I mean, let's go really stupid question from a host is like, for a company that like installs computer systems in the companies, does it ever cross your mind that like not much happens around Thanksgiving and Christmas? People
that
take
doesn't
time
matter.
off.
That's a great question, but it doesn't matter. And here's why.
Go on.
What matters to you, that happens every quarter. When you talk about stocks, you look from this quarter to the same quarter the previous year. So it doesn't matter, because whatever happened this year, this quarter, is going to happen last year, and it probably happen next year.
Oh, I see.
So it's always comparison from quarter to quarter.
Okay, good point. Okay. Guys, we love the comments. The likes are completely absurd.
Cameron, I like Cisco.
Love it, guys. Okay, Paul, let's get into our second company today.
Intel. And the reason I want to talk about Intel is because I'm building a position in Intel. And I want everybody to understand why, okay? And this will be showing my full analysis of it. So look at this, guys. Intel, I view Intel the way I viewed Microsoft in 2012. Perceived as a dead company, perceived to be not the most cutting edge, but generated great cash flow at a low multiple. So you can buy the company in full for $180 billion. That is the price I'm worried about right now.
Why do you say that right off the bat for our normal view?
Not worried about it. I'm just saying that's what matters to me. Price of the stock doesn't matter. It's the price of the company,
so
which is the number of shares multiplied by the share price.
Again, folks, if you're new to our channel and you think that the stock, buying or selling a stock has to do with the price, which I did for the past decade, that's absolutely the last thing we look at. And Paul's going to build a foundation with our 8 pillars, build a foundation for a company. If it holds up, Then we'll go back to price and see what Paul likes to buy at. Paul, I thought I said that really well.
I think you did do it well.
Great. What is the PE ratio for this company?
8.6 on the PE, guys. So this is literally selling for every dollar of profit it makes, you can buy it for $8.60. That's pretty incredible. Okay. Profit margin.
Pillar number 2.
23% here.
Ooh,
a little bit higher here. It's actually about 26% for the last year. So check mark there. And the gross profit is 53%. And Nate, make sure you go to the wider screen whenever I'm on the board.
Yeah.
Isn't there a wider, this one right here?
Yeah.
That one right there. Perfect. Perfect.
Okay.
Exactly. So right now, if you want to go to it, right now, we're looking at 23% quarterly profit margin, 8.6 PE, and a gross margin of 53%. These are all very, very good things. So stay on that view right there, Nate. Just stay on that one.
Okay, let's go. Pillar number 3 is revenue growth over the past 5 years.
Okay, so revenue growth, I don't think is going to be that great. Oh, actually, it is pretty good, but they probably made an acquisition. That's why. So if you look at this revenue growth, 55.4, 59, 63, 71, 72.
Very nice.
Check mark. Big jump here. So something happened here. They probably bought some company, but the whole point is good check mark there.
Let's go to profit growth over the past 5 years.
Guys, look at this insane profit.
Tell me about it.
11.4, 10.3, 9.6, 21, 21. Check mark there. Guys, this company just makes tons of money right now.
Intel, you already purchased some of this, Paul?
I've already purchased it, and I have more coming in.
David S. Pumpkin says the only major concern with Intel is they're losing their gaming market more quickly than expected.
You might be correct. And that's a really good point, David. And I would want to make sure that we understand that that's what usually drives stock prices down is news like that. Might be over exaggerated, in my opinion. Like 2012 in Microsoft, it was they're losing to Google, they're losing to Apple, all these people, when in actuality, they had great stable cash flows that was growing, and they were able to go make acquisitions and turn their business into more cloud computing, and now they're dominant. Again, so
we already have some Nate the Great fans coming in, Paul, already. So they're already loving him already.
Oh,
so,
Nate?
Yeah, it's
awesome. All right, number of shares outstanding, 4.74 to 4.4. Guys, I think this might be another good check mark situation here.
How about current assets over current liabilities?
Okay, current assets, guys, is 37 billion right there. Current liabilities, 22 billion. So massive check mark there, guys. Another check mark. Now for my favorite metrics.
Pillar number 7 is free cash flow growth.
Free cash flow growth. Perfect. We're on the right screen. Now this one Intel spends more money of their capital, of their spend more of their operating cash flow on capital improvements, capital expenditures, which is reinvesting back into their fixed assets. I keep looking at the wrong camera.
That's okay.
Keep going back into their fixed assets than most companies, but that's okay because they still generate good cash flow.
Okay, keep going, baby.
So going back 5 years, it's 11.7, 12.2, 10.3, 14.3, and 17. Check mark there. Seth, what do they add up to?
Give me a second. 14.3.
31, 41, 53, 64, 65.3 divided by 5 equals 12 equals 13. Times 20 equals 260. Check mark, check mark, check mark, check mark, check mark, check mark, check mark. Guys, so this is another one that hit every single metric, hit all of our pillars, and is selling for...
The market cap is 180.
180, and we think it's worth between 200 and 260. I am buying this, not because it's going to grow 1 billion%. I'm buying this because it's a good, big, market-leading company that generates a lot of cash flow and generates income, and I like that a lot. And they're paying a 3% dividend. Not fabulous, not bad. The market currently pays like 1.8% or something like that.
Chip is saying, why did you multiply by 20 one more time? Go ahead, tell us.
Chip, so this is a subjective number. I just picked 20 because our PE, your earnings, a company's earnings and a company's free cash flow over long periods of time should equate out. So I picked 20 the same way I picked the 20 for the PE. Now this number can fluctuate. A fast growing company should have a higher multiple. We may multiply by 25. A slow growing company like this one might be 15. But even at 15, guys, this is still selling for lower than the current market, than the current value we put on it. This is not going to be a fast growing company for you, but I believe this is a low. Here's what I always tell people. When people say, hey, this investor got me 12%. That investor got me 10. Therefore, the 12% investor did better. No. Not necessarily. If they took more risk to get 12 than you did at 10, it's a worse. I think this is a company that can get you 10 to 12% a year without taking on much risk. That is why I like it. I would rather make 10% with 80% less risk than 12 or 13% with 4 times more risk. Does that make sense?
That was said very well.
Oh, thank you. That was off the cuff.
So this is 2 straight companies. Paul, I usually complain when we can't get companies that we're ready for buy, but this is incredible. 2 straight companies that you're in love with, and maybe your viewers should be as well. I challenge our viewers. Paul, you're not going to believe the number watching. The likes are incredible, guys. I imagine we could get. This is going to break every live stream we've ever done. Make sure you're smashing that like button right now, pretty please. You guys don't need a dime. Give us a dime of your money. Just smash that like button, and YouTube will pay us so we can do more things, including a Patreon page that gives you more exclusive access to Paul. We're doing an app for your phone that's going to be part of the Patreon that you can click all of these 8 pillars and they'll bring it to you really quickly. And so the app is being developed. It costs a ton of money to run, and Paul is forking over all the dough to get this done. And in the meantime, I challenge you to one more thing. There's a share button in the bottom right corner. If you've had discussions with a neighbor or friend that maybe they're new to getting it. Listen, I have doctor friends, lawyer friends, I have on all aspects, spectrums of the workforce, and some of them are still not investing up into their 40s. And if you have a friend, a brother-in-law that needs to hear this, I'm telling you, I look at all of our competitors doing this on YouTube, and this guy, Paul, knows his stuff. It's obvious. And so, yeah, go ahead and share that in a text to somebody and see if they can jump on.
Now, let me tell you guys what I'm doing with Intel. So this is very important to me. What I'm doing with Intel is I'm buying puts on Intel. Selling puts. Sorry, I'm selling puts on Intel. So what that means is this, guys. I'm selling somebody the option to force me to buy Intel at a price determined in the future. So for example, Intel's currently at $44 a share. Okay? I'm going to go to somebody and pick a date. And let's say I pick, I'm looking, November 27th. At $40 a share. So November 27th at 40. What this means is I'm going to sell somebody for 50 cents a share the option to force me to buy Intel at $40 a share. So let's say I sell 1,000 shares worth, which is 10 contracts. They're going to pay me $500. So I'm going to get the $500 in my hand. If on November 27th, Intel is selling for less than $40 a share, they can force me to buy it from them for $40 a share. I keep the $500, but I'm forced, let's say it goes to $39. I've got to pay them now $40 to get a $39 stock. I lose $1. I got 50 cents. I basically end up losing 50 cents per share. But if it's still above 40 at November 27th, I keep the 500. And nothing happens. I just keep the $500.
What if it never reaches 44? Someone said. Did you just answer that?
No, it's 4. Right now, it's at 44.
Okay.
It's at 4. I'm selling the option for $40. I can pick a ton of prices. Mm-hmm. I can pick higher, lower, whatever I want. But the reason this works for me is a lot of people do this as part of options trading. I don't trade options. The reason I like this is I want Intel at $40. I like it at 44. All I'm doing here is getting paid to wait for it to hit 40. And if it doesn't hit 40, I make money. How much money? Let's put it this way. 50 cents on $40 is 1.25%. I'm getting 1.25% over 30 days, which is equal to 15% return on my money. So if I do this over and over and over again, I'm going to make 15% of my money. What's the risk? The risk is the stock goes to 30, some catastrophe happens, it goes to 30. But you know what my comment is? Well, I was going to buy it at 40 anyhow. The real risk is in sometime in the next 30 days, something changes fundamentally in the company, a scandal, accounting scandal, and I don't think it's worth 40 anymore. I'm like, oh my God, it's worth 20. That is a risk I take. If I do my thorough analysis, I will eventually have these happen. But if I do thorough analysis and do this across 30 or 40 stocks, I will be okay. But I'm getting paid 15% of my money to wait for the stock to go to a price I want it to go to. Now, the reason I like doing this right now is I have a lot of cash sitting around. So I'm generating income, 15% annualized rate, 1.25% per month, waiting and waiting and waiting. Mm-hmm. Now, the downside for you guys is You have to do these in 100 share increments.
That's what Jeff is saying. He says this needs to be its own show. So Chip is wondering, he's never bought options. How does he get into this?
These are selling options, and we will get in this in another show. I do not recommend doing it right now, but this is what I do to generate income to buy stocks that I want to buy at lower prices. In the future, as I do more and more value investing, as I build a position, I will always be doing this. And it's a good way for me to generate income. I do it now to pay for our other startup Dynasty owner that Tim runs, but it's a great way to generate income. And I only started doing this in the last 6 months, and I'm really happy I did it. I've generated some good income for us for doing this. And I've only lost a few bucks at a few trades. The rest of the time, you just wait and wait and wait.
Yeah, Paul, as soon as you fire up about options and puts, the comments just roll in. I see you guys. Kate, I see you. Alex, you're absolutely right. We should do a full show on this, and it does take a ton of money to get into this, Paul.
Matt, to answer Matt's question, you're right. It is $40,000 is needed, because what the bank's going to tell you is 1,000 shares, you need to be able to support having $40 at 1,000 shares. So the bank's going to sit there and say, you need $40,000 lying around waiting for you. That's why if you have, but I'm just showing you guys how I invest so you guys get an understanding of it. This is not something that's done on a small scale with a small IRA and like that. This is something that's done for bigger accounts. And I'm not saying it to be cocky. I'm just saying it as a reality. But this is a way that I'm going to beat the market over time to add 1 or 2 or 3 percentage points a year. That even though I match the market, doing this will put me over the hump.
So Matthew said something to the effect of, in actuality, someone's shorting you. Is that the way you can think about this, or not really?
So Michael, is that Michael Mathern's name? Who asked it? Michael, great question. You can use options as a way of shorting without having the big risk of it. That is correct, with a limited time frame. This is just, in a way, it's not really shorting. It's just me sitting there getting paid a small amount of money to wait.
Yeah, Jeff is saying we need an everything money options channel.
Well, we have enough channels. We're going to start the Trader Mo channel soon. But
okay,
there's a lot of things to go into this thing. There's a lot of discussions to have about this. The bottom line is I'm showing this to you guys so you guys understand how I invest and how I can make increment. Unfortunately, guys, this is an example of the more money you have in the account, the more money you can make from it, because options are expensive. So imagine if I'm selling options, the same thing on a company that's $150 a share, $150 a share. And I have 1,000 shares outstanding, 1,000 shares in the option. That's 150 grand. That's a lot of money out there, right? So right now I have many, many, many 7 figures in options out there. But I'm collecting income along the way for it. So and some of them are long. I have some options that go out 2 years, and I have some options that are due tomorrow, literally tomorrow.
If someone wanted to start on like penny stock options, Paul, is that absurd?
I don't think penny stock options are. There's a lot of volatility there. You can get yourself wiped out very quickly, because options do have theoretically not unlimited downside, but they're like, I have options. I have some options that went the wrong way very quickly, and I'm down 300% on them. So I've lost more money than I've invested. But as long as I hold them through and they turn around, I'll get my money back.
Trader Mo has joined the chat. He is our day trading specialist.
And I agree with David Spicer, by the way, that Intel is not, I don't think AMD is going to replace Intel.
So if there's any questions that we're not getting to, feel free to ask him to Trader Mo, and he will answer. He's trading hundreds of thousands of dollars every single day, up and down. Jeff, thanks, guys. I see you all there. We welcome all the new people jumping in. Paul, I think people want to get into either Microsoft or AMD.
Let's do Microsoft, because Microsoft's another great financial company in terms of their finances. But what's the big but?
I don't know.
The big but is they're overpriced.
Okay. And Hector, I would love to get to Adobe as well.
Adobe will be a good one too.
Oh, good. I've been using Adobe for 10 years. I love their products, really do. So,
okay, we're gonna go to Microsoft right now.
And with that said, Paul, one of our guys, listen, we absolutely love, guys and gals out there, we love your comments. Someone said, Paul, this is gonna be so helpful. We'll have Don moving forward. We'll have Don put the timestamps of all the different stocks that we talk about in the description after the live stream. And Paul, I had a talk with our editor. I think we're gonna start pulling out that bit you just did on options, we need to pull that out and make it a separate video altogether. A short.
I think we should just make a video.
Well, we'll do both. I mean,
Yeah.
just more. We'll provide more content and all that. Again, guys, Paul and I have so many plans for the Patreon page beyond what you're seeing right here. Yeah, that's right. Yeah. So here we go. Okay, let's go in with Microsoft.
So
Paul,
this is a company, guys, that I bought at $22 a share in 2012 or whatever it was. Everybody told me I was stupid. Went to $55 a share. I felt like a king. I sold it all. Now it's at 200 and what's it at? $210 a share. Guys, it's a $1.5 trillion company.
Oh my God.
It's insane. Now, PE. 33, guys.
Now you're
this is an expensive company.
You're
now,
liking that.
I'm well aware of where Microsoft stands, so I can tell you right now that it's overpriced. However, PE itself does not tell you the full story. There are multiple reasons why PE can be high, including a random chart write-off that occurred that year for something that was one time. But in this situation, it's bad. But look at their profit margin. Guys, their bottom line profit margin, 37%, and their gross margin is 70%. And it jives with their net income. I mean, this is a very, very, very profitable business. It's software. Once you make the software, repeating it over and over and over again costs pennies. This is a great, this is a great margin company. But this will be a prime example that we'll look at.
Pillar number 3 is revenue growth over the past 5 years.
These mofos love making money. 91, 96, 110, 125, 143, check mark. And I believe this isn't acquisition driven. I don't think they've been, what, you laughing at these mofos love making money? They do. This is all, I mean, they have made acquisitions, but I don't know what sizable acquisitions they made. We can look on their cash flow statement, but guys, these guys are insane. Ready for this?
Make sure you're smashing that thumbs up real quick. Just reach down and clip it for us. I love you guys. Go ahead, Paul.
Profit, 20, 25, 16, 39, 44. Another check mark. Something happened here, probably a big write-off. That is fine. We're going to ignore it. Big check mark here. $44 billion in profit last year. And guess what they did with that money?
Pillar number 5 is shares.
They decreased their shares.
Because they bought their shares back, Paul?
They bought some shares back,
Explain that to normal folks.
So guys, remember when we talk about shares outstanding, if there's a company with 10 shares and you own one of them, you're going to own that share. Now, let's say they buy 2 shares back. You now own 8. They're now 8 outstanding. You own 1. You now own 12.5% of the company versus 10%. If they all of a sudden you issue more shares, make an acquisition from 10 to 15, you still own that 1 share, but now there's 15 shares outstanding. You own 7% of the company. That's why I look at decreasing shares as a way to see that a company cares about me as a shareholder. Because a lot of companies will issue a lot of shares to go make acquisitions, but it hurts you as an existing shareholder.
Kate was saying the tagline for Windows 11 should be "These mofos know how to make money." These mofos love money. Kate, I love
Hire
that.
Kate as our marketing expert.
And I tell you what, the marketing ideas keep flowing in, Paul. Someone said, okay, just like Joe Rogan, we should have the Everything Money clips. Or Jeff just said, how about the money clips? We got to get that channel right now. Don't take it from us. Tim's on his phone right now, getting that channel right now. Yeah, Malik came in late. Malik, just rewind a bit. We've gone over Cisco and Intel, and for the first time ever, they're both all check marks down the board for our 8 pillars. Huge buys in terms of Paul's.
I'm not saying huge buy. Still do your research,
I'm saying
guys.
Huge buys.
Before I came in today, I was reading the 10K on Tyson Foods. I liked the numbers, but I was reading the 10K on Tyson Foods. By the way, they didn't have high profit margins, but I still liked it. But either way,
we are on pillar number
cash on hand. Guys, Microsoft has $177 billion of cash on hand.
This is pillar number 7, current assets greater than current liabilities.
They can pay off all their debts, everything with their cash on hand. This is the mofo. So they have $177 billion in cash, $177 billion in total liabilities. Their current liabilities are only $70 billion. So this is the holy grail of all balance sheets. Total cash, being able to pay all the company's liabilities, not just the current ones.
Okay, and now Malik is happy because he says he bought Intel this morning. I thought he bought Microsoft. Keep going, Paul.
By the way, Malik, that takes some guts because Intel's down a lot today. So good for you on buying Intel. Yeah, good stuff.
Let's go to pillar number 7 is free cash flow growth. This is one of Paul's most girthiest pillars, I would say. Wouldn't you agree?
Love girth.
Keep going.
25, 31, 32, 39, 45.
He's burping up lunch while he goes.
I am. I had some fang.
Okay, go on.
56 and 32 is 88. 127, 172. Divided by 5 equals 16. Is it 16? No, not even 16. 17. Let's call it 17 times 20. Oh boy. Did I do this? No, I did this wrong. No. Not 17. Guys, I'm stupid.
Go ahead, take a minute now.
30. What's 172 divided by 5? 30 and 32, 37?
34 and a half.
Okay, we'll call it 35.
Okay.
Times 20, 700 billion. Guys, this company needs to fall in half. And you know what? It makes sense based on their PE. Their PE was 33. Historical average is 15 or 16. It needs to fall in half.
Circle the where we're at again, Paul.
So right here, guys, the PE of Microsoft is 33. Now,
this would make sense because we want our PE down near 15. So all of this is sort of making
in
sense.
2012, I think they got to 7 PE. So these things do happen. This is a company that, as you'll see, from 2000 until it took how long? It took from 2000 until around 2017 to even hit the 2000 mark. And then it just went straight up from there. This company will sell at a lower price. It's at 205 right now. It'll sell at a lower price sometime in the future. It's a fall lot. Now, am I willing to pay more than $100 a share for Microsoft? I think so, because of how stable it is. It's not paying a good dividend, but if the stock falls in half, this dividend's going to go up by double. So I'm not sitting there. I would not buy it at 205 where it's at right now, but I would be looking at it around $100 or less per share. That will happen, or it will be selling for some metric that is equivalent to $100 a share today. Because when I sold it at 55, I thought it was worth 40. And since then, it's now worth 100. So these things do increase in value. And as the world gets bigger and more internet-based and all that stuff, Microsoft's going to grow with it. They just announced earnings the other day, and their cloud computing business, which everybody loved about with Amazon, has made major strides. So I like the company.
Martin, I see you there. Paul, will you remind our viewers where they can find these financials if they don't have access to the Y charts?
Great question. Yahoo Finance, Google Finance, or when our app is done in 9 to 12 months, our app will have the financials going back 10 years as well. And the app is currently being developed. We actually have our developer. He started it last weekend. It's going to be a slow process because he's not full-time, but it's going to be awesome.
With that said, Marcos is correct, Paul. We need to take a deep breath for a small moment of likeness, pretty please, with sugar on top. Dear Lord and baby Jesus, if the viewers now can just smash that like button, that'd be wonderful. I can make more money. My son Gio, who's on the chat, can go to college finally. It'll be great. I can pay for that overpriced car.
Finally, he's 10.
I know. I can pay for that stupid car I bought outside. And yes, okay.
And Aaron, I like Market Watch too, but I think Market Watch is starting to get into what's it called? Into charging users for access. Now, if you have a brokerage account, any brokerage account, put $500 in there at Charles. I thought about this the other day. Put $500 in there, Charles Schwab, open an account, they'll give you financials.
Really?
Yeah, you're part of their research. So I thought about the other day of way of getting free advice, free info. You all have brokerage accounts. You have an IRA. You have something.
Well, maybe not, Paul.
Well, if they're on this channel, they're probably investing in something.
That's true.
So open a free brokerage account or put $500 in there, put whatever minimum's in there, and just have that money in there and use the account for research.
If you're watching us for the first time, put in the chats if you'd like to get started in real estate or you have nothing. There's nothing to be embarrassed about. This is confusing math. Trust us. And I would say it's rather, Paul, it's rather boring. We're not smashing cars and racing. I mean, we're not doing crazy stuff. We're talking about math and investing and discipline investing. And so share with the new viewers just your overall thought on investing in these things, the discipline it takes.
Discipline's everything in investing. There are 28,000 companies out there that are publicly traded. Your job is to find 20 or 30 good ones. So be selective. That's all I'm doing every single day. I'm looking for companies, looking through lists, trying to figure out ideas. Part of the reason why we started this channel was I've already bought some stocks that we bought. Walgreens, by the way, is down a lot today. I bought Walgreens because of this channel, and I'm probably going to add more to it. So these are the things that you have to learn along the way. The discipline takes time because we all want to see stocks go up. But at the end of the day, what matters is buying stocks at good prices. It is better when stocks are lower because stock prices are lower, buy low, sell high. But it's very hard to do that from an emotional standpoint, from a discipline standpoint. I brainwashed myself properly. I brainwashed a lot of people around me for that. You just got to sit there and say, I almost sit there and tell people, look at financial statements without knowing what the company is and forget about the price of the company. Mm-hmm. Just do your analysis and say, what's this worth? And then go open up and say, okay, now, will your worth change based on the company? Absolutely. Because you have to understand there's qualitative aspects, not just quantitative. We are focusing on the quantitative aspect of these things with the financial statements. But qualitatively, understanding the management, understanding their market, things like that are the things that you have to do and learn as you go along.
I think these 8 pillars really set up the foundation of this
Correct.
company. And then you can look at the title or the billboard of what it is.
Yep.
And hopefully
the 8 pillars are not a buy or sell. They're to tell you, if I dig deeper, what am I going to learn more about it to even go dig deeper? That's what I use them for.
Paul, would you like to get into IBM right now or Adobe? I love Adobe.
Adobe. Let's do it. We've
Adobe.
done IBM before, I think, haven't we?
At some point back in the day, we might need an update, but yeah.
Adobe.
And Caesar, we did an episode a few weeks ago on Paul's portfolio, precisely what he's buying. A lot of it is options and puts, but he has, I would say maybe 20 total stocks that we went over.
No, not even.
Not even.
No.
And we talk about them very often.
Guys, look at this chart.
For Adobe?
Yeah, this is parabolic, guys. So from a trading standpoint, this scares me. Like, this is begging for falls. Like, nothing goes parabolically forever. Nothing.
Right off the bat, this is scary.
This is scary. So first off, PE 58. So we're already at 4 times more than we want to be, 3 times more than we want to be, right?
Mm-hmm.
So guys, we're going to still go forward, but keep that in mind because there's other aspects of the company that if you find that you like, you put Adobe on your back burner and set an alert on your stock saying, notify me when Adobe hits X price. Because this is still important to look at when you're looking at companies. I don't just look at companies I want to buy today. I look at companies that fit my criteria, and then I put on my watch list and say, tell me when it hits this price, because I want to be buying that.
Yeah, that's a great point, Paul. You're not saying these 8 pillars aren't saying that this company's terrible. It could be incredibly awesome. It's just now is not the right time to buy. So again, folks, the market goes up. Mr. Market goes up and down. Paul, give me that analogy.
So Mr. Market is going to tell you every single day, here's what the price is. Your decision is, are you a buyer or seller at that price? The market is just going to say this is the price. But is it right or wrong? Are you telling me that Adobe is really worth 1% more today than it was yesterday because of something fundamental the company did? No, there's no extra information out there. So your job is to decide, am I a buyer or a seller? That's it. So the first one was an X.
What about profit margin? I assume it's enormous.
30% bottom line, 87% gross margin. That means every extra dollar they make, 87 cents goes to the bottom line. That is huge. But they're a software business. That's expected. And by the way, they make great effing software. Do they not, Seth?
It's flawless the way it works.
This is a leader.
It integrates in itself. It works on a phone, an iPad. I use it every single day, and it's incredible. I love it.
Okay.
Let's do revenue growth. Pillar number 3.
So that was a check, by the way.
Is revenue. Yeah, we have 1 X and 1 check, a high PE of 58. And we're going to revenue growth, pillar number 3.
4.8, 5.8, 7.3, 9, 11.1. Check mark there, kids. So a growing company. I don't know how much that's from acquisitions, but it is growing nonetheless.
Of course, I would assume profit is going up as well. Pillar number 4.
630, 1.1, 1.7, 2.6, 2.95. Check mark again.
Great.
Number of shares outstanding.
Pillar number 5 is shares. We want this going down, folks. We don't want them selling new shares or making up shares. We want this to go down, Paul.
Check mark. They have about 12 million less shares outstanding than they did 5 years ago.
Pillar number 6 is current assets greater than current.
I bet you this is going to be a very good number. Their current assets right now are $7.4 billion, and their current liabilities are 5.1. So check mark there. Now,
how about total liabilities?
Total liabilities is only 10.7. So they almost have enough cash on hand to pay all of their debts off. Not enough, but pretty solid. This is a good thing, but they definitely have enough to. The cool thing is almost half their liabilities are owed in the next short terms. They don't have a lot of long-term liabilities.
Pillar number 7 is the number 1 stunner, free cash flow growth.
Free cash flow growth, baby. Let's do this. Seth, you have your calculator out?
I do, yeah.
Oh, wow, look at this. A big chunk of their cash from operations, a big chunk of it goes to free cash flow. They don't spend a lot on capital expenditures. So here, let's call it 1.3, 2, 2.2, 2.7, I mean. 3.7 and 4. So 3.3.
13 and a half-ish.
13.5 divided by 5 equals 2.7. Times 20 equals 54 billion.
Now we leave people in the dust with this math real quick.
Okay, so guys, I'm taking the average. The average of the last 5 years has been 2.7 billion in free cash flow. I'm willing to pay. I start with a number of 20 times. If I were to pay 20 times free cash flow, that'd make the company, I'd have to buy it for under $54 billion. Now, that 20 times number is just like PE. It can go higher or lower depending on how fast or slow the company is growing, what the news is like. I think 20 seems reasonable for this company because they are growing well. They are a leader. And their balance sheet and financials are very solid. So 54 billion is what we want to pay for the company. What's it currently selling for?
I missed. We didn't look at the market cap right off.
Look at this.
Oh boy. Did you
220.
Did you say 54 billion?
Yep. So remember I said before the PE was 58 and it was 3 or 4 times more. What's 58? What's 54 times 4? About 220 billion. Yeah. So the PE and the free cash flow are pretty much in line. This is a no right now, but
what price do you like this, Paul?
1/4 the price right now. So what is it right now? See, I didn't even look till now. 460, 115 or so. That's set in stone. Set a mark at 160. Because by the time it gets to 160, it might be 2 or 3 years from now, and it takes time, and they've grown more, and they might be worth 200. So maybe even set a mark for 200. Whatever it is, but this company is definitely overpriced right now. You cannot pay this. I will tell you right now.
Go on, Paul.
What I think you're going to make in return. By paying current price for it right now. Assuming everything the growth stays the same, which is that big expectation, and the profit margin stays the same.
We have certainly reached a record for number of viewers. We can't thank you enough for following along. Make sure you're smashing that like. That's incredible as well. Paul and I will be jumping like cheerleaders in joy after this episode at your support. We appreciate it. Paul, if
you assume that their growth will stay the same for the next 5 years, and if you assume their profit margin stays the same for the next 5 years, which is quite the leap, but assuming that, you're going to get a 6% annualized return by paying $460 for the company today.
Is that good or bad? Sounds bad.
Well, 6%. I look at it going, the market does 10% a year. You want to find companies that your return will be in excess of 10% a year, because you're going to be wrong on some of them. I look for 15% a year because I want to be, and it takes a lot more time to find that, but I look for 15% a year because if I'm wrong on a few of them, I need to get the big winners that do better to overcompensate for the wrong ones. But at 6, if you bought all these stocks that were like this, you're going to only make 6% a year, but you're also going to have big drops, because when stocks fall, especially when we see this chart, guys, this chart, when stocks do fall, this is going to be a massive fall. It's going to be a massive fall. Look at the last month. Stocks have been down this week. Look at this. It went from 515 down to 460. That's 10% drop like that in 1 month. So anyhow, with Adobe, it's a great company financially. It's just priced too much, too high. That's pretty much it. So anyhow, that's Adobe right there. And it's 152. We're running low on time. However,
Paul, don't you have a 230 or something?
I have a 245.
Oh,
why, you want to go longer?
Well, look, Paul, I mean, this is a smashing.
We have
episode.
91 people watching right now and only 78 likes. Guys, let's get to 100 likes here, and I will go an extra half hour because we have other companies we need to look at.
We have so many requests, Paul. I mean, earlier on, if you're still on, our OGs were asking about Palantir.
Well, I also want to answer Jeff's question.
Go ahead.
Jeff said, keep a spreadsheet with stocks you like and the price you'd hope to buy it at using 8 pillars. So remember, the 8 pillars don't tell me what price I'm going to pay. But for the app, when we have it, part of the access to me that you'll be getting will be all the stocks I'm looking at and the price I think they should be bought at. Now, remember, I'm a very conservative guy. I can afford to be out of stocks for a long, long, long period of time. Just like real estate. I was sent a big property yesterday. And I told the owner, for me to do this, I got to pay X. I thought it was actually worth more, but I thought with the hassle and being in a different market, I sat there and said, I have to pay this to do it. So this is the way I view my investments. It's different than you should. You shouldn't even put all your money into the stocks you pick. You should put 5 or 10% of your money aside and say, I'm going to pick my stocks with this, and it'll be fun money. That's what you should be doing. The rest of it should all be dollar cost averaging into low cost ETFs and saving for your retirement. That's what you should be doing.
Lars, if you just joined, we're welcome to have you. I'm glad you're here. Yeah, we did Cisco right off the bat. We loved Cisco. And if you just rewind to the beginning of this episode, you will see it. Benjamin is right, Paul. He's saying we could do probably 3 more episodes on tech and still get requests.
Guys, get to 100 likes in the next 4 minutes, 5 minutes, and we will do
add 30
extra half hour.
Great. Paul, people are asking for, you said you didn't want to do a Palantir.
Oh, what is it? Give me the ticker symbol.
I don't know what it is, but a few people were asking for it earlier on.
How do you spell it?
Palantir, I hope.
Oh, there we go.
Oh, there it is. Kate, thanks, Kate. And what is STX, Paul?
I don't know. I'll have to look it up.
A lot of people David S. Pumpkin sells with that. A lot of people are asking for that as well. But keep going.
Okay, so Palantir.
Oh, Seagate, of course, Seagate.
Oh, Seagate Technologies.
Yeah, but Palantir, let's get on it now.
Okay, Palantir. What do they do? Somebody tell us in the group chat, 'cause I can't read this whole thing. But here's the deal. Ready?
Here we go. What is the market cap of Palantir?
17 billion.
Not bad. Okay.
What's the PE?
PE
Negative.
ratio. Uh-oh.
They don't make money, guys. I don't want to go any further. So this is my comment.
Come on, Paul.
I don't want to go any further because I think there's other companies we can look at.
Tell me why.
They did $900 million in revenue in the last year and they lost 460. They lost 50 cents on every dollar they brought in. This is a company that has a lot of growth potential, I'm sure. And I look at it going, I'm not touching it, but if you want to do it based on, I mean, look at it. They only have 2 years of financial data. And their 2 years, they lost $1.1 billion in the last 2 years. That's a lot of money to lose on $1 billion. They've lost literally $1.1 billion and they brought in $1.3 billion in revenue. It's a startup. They're running the whole stock market craze. If the tech bubble bursts like David Einhorn thinks it already has, this will be one of the biggest falls. I just don't even look at it. I like to find companies that are strong, stable cash flow, that are established. I wouldn't even put money on a flyer for me for this. If you want to try it, that's on you. Great, more power to you. For me, I just avoid.
How about Seagate, STX? We'll jam that out quick.
Okay. Did we hit 100 likes yet?
Not quite yet.
Guys.
We're running low on time here, guys.
Guys, 100 likes. I need it.
Gio, log out of my son, Gio, log out of my account and jump onto another account.
You're manipulating the data.
Another one of mom's emails and get in.
Okay.
Yeah. Keep going, guys.
Seagate. Ready? So to buy this company, $12 billion.
Okay,
to buy every share of the company outstanding. First metric, PE. 12, check mark.
Boom,
okay.
Like
already selling for less.
We want our PE under 20. Go ahead, Paul. Pillar number 2 is profit margin. I assume it's huge.
It is not.
Uh-oh.
It is 9.6%. It's technically an X.
Oh, boy.
It's technically an X. Not the worst thing in the world, though, guys.
Okay, go on.
But look at this. Their dividend, that really catches my eye. 5.6% dividend. So
wow,
that's a huge dividend. We want to figure out if the dividend is sustainable.
Now they're already they're requesting the old Seth stall.
Yes, exactly.
They're requesting the Seth stall. So I might go into some stories about my childhood, visiting.
And I'll just walk off
with my family.
Guys, come on. 86 people watching. We can't get 10 more likes.
They're trying, Paul. They're trying. A lot of them only have one thumb, damn it. All right, let's keep going, Paul. Let's go to pillar number 3 is revenue growth for Seagate.
11.1, 10.7, 11.1, 10.4, 10.5. Okay, so their revenue is falling. We have to understand why that is. It's not exactly the worst thing in the world, but look at this, guys. In 2012, they did 15 billion. And this year they're doing 10. That's a big drop. Is that because...
Let me just pause you real quick.
Yeah.
Tim Peffer, our dear, lovely Tim.
Are you stalling?
He just got the handle money clips for us, Paul, for our secondary clip show. How is that available? Damn it, Paul. That's incredible.
Jean-Marie wants merch. We'll have merch soon.
Can you imagine a t-shirt with my face?
Oh, look at that. Money clips in the house.
Money, he's already liking and commenting. Money clips. Can you imagine a shirt, Paul, with your face? It just says, I get my financial advice from my Uncle Paul with your grin on it. I almost cursed right there, but
all right. I got to finish this company.
Okay.
So their revenue is down 35% in the last 33% in the last 8 years. This, I would bet, is because they sold off divisions. I'm not sure, but we'll see what the reason is along the way. Where's profit?
Okay, profit growth is pillar number 4.
Okay, now this is weird. It's technically up, but it's very all over the place. I mean, this is strange, guys. This is leaving me a little uneasy, but we have to do a lot of research on this company. Number of shares outstanding.
Number of shares outstanding. Pillar number 5.
Check mark.
And a merch shirt that says the good old Seth stall as well. Okay, pillar number 5. We want the shares decreasing.
95, guys. We're gonna be done here. What's Jensen saying? If you try to like it twice or it moves your like. Good call, Matt.
Good call, man. Don't want to do that.
Okay, $4 billion in current assets, 2.6 in current liabilities, 7 billion total. So this is a check mark. This is a check mark. 4 versus 2.6. Definite check mark there. Now for the very famous price to free cash flow. Now, guys,
you did assets over liabilities, Paul?
I did. Okay, it is a check mark.
Yeah, very famous. Pillar number 7, good old number 7, free cash flow growth.
Now, the free cash flow, 1.1, 1.5, 1.8, 1.1, and then 1.2. It's technically a check mark.
6.7.
6.7 divided by 5 equals 1.3.
Yeah, 1.3
times 20 equals 26 billion. And it's a check mark there because it's selling for 12 billion. Now, I will say this, guys. Here is where a little bit more homework is due.
Go on.
On the statement of cash flows, there is something called net divestitures and acquisitions. If it's a negative number, it's an acquisition. If it's a positive number, it means they sold the company. Remember I said their revenue is down 33% in the last 8 years? Guys, unfortunately, this is a red flag for me. I don't see any sales of assets.
Uh-oh.
So, I don't think 20 is a reasonable number. Okay? Now, with that said,
this looks like a Paul stall.
This is not a Paul stall. How many do we have? How many likes do we
97.
have? 97.
We're getting there. It's going to happen, Paul. I mean, people are coming in. They love you. They love you. They love your camel sweater and those beautiful.
Yeah, but
jeans.
I don't want to be known as the guy who's like always giving people
more for less, Paul. You
Yes.
are that guy. Damn it. You're giving it all away. All this knowledge, Paul. Look at me. Guys, as Paul's typing, I would say that as a normal person with not that much money saved and not that great of a job, this guy has completely turned my entire life
don't
around
be weird.
over the past 2-3 years. It just, you got to talk. We'll have Beth on to continue this. Just having this guy in my life, I run all my financial decisions through you, and you can do the same. And so we just hit with 100, Paul, and now it's dance time.
A minute late.
That's
we
okay,
hit
buddy.
100. Okay, guys. So
Okay.
go back to Seagate.
All right, cut the music. Here we go. Sorry, guys. I love you. Keep
I
going.
don't like the stock because of, even though it's selling for a good multiple, you're going to sit there and say, but Paul, it's selling for less than you want to. But guys, the big thing here is the financials didn't tell me a good story here.
Uh-oh.
Now, these revenues going down so much over the last decade is a problem for me.
Ain't nobody got time for that.
If somebody, you should be doing more homework on this because this does seem odd. How could their revenue be down so much about selling off assets? Unless that line, they had a big sale and they also spent more in acquisition. That is possible. But from the standpoint today, I'm not buying this company right now unless it's under $30 a share. What's it at currently?
Oh, boy.
And the reason being is it's at 47. And the reason being is I still believe that a company that's losing revenue and decreasing profit is still worth something. You have to account for the decreasing revenue and decreasing profit. You have to account for it somehow. And the free cash flow is too around the board. Here's what they're doing. They're paying a big dividend, guys. Their big dividend of 5.5% to me is their way of saying, hey, come invest in us. Because a lot of companies will do this. They will pay a big dividend to get you interested in the stock.
That's huge. I mean,
they can afford it.
Okay.
Because right now their dividend's about $700 million a year and they generate an average of 1.3 billion in cash flow. So they can afford it right now.
Okay.
But the whole point is, I'm not saying this is not a dividend trap in the sense of they can afford it, but the company losing value, it's interesting because I like the fact that people probably see this and go, this sucks. We had to do more investigation about why their revenue is down so much and what are they doing to turn that around.
Jeff makes a great point. Don't buy the stock because of the dividend. I do see people saying
Correct,
that
Jeff.
right off the bat. To see a high dividend, go for it. So
nope. You should understand, is a dividend sustainable? And is the company itself a sustainable company?
And I think that's important to realize. I never knew that, Paul. As a dummy investing in the years past, I saw a high dividend and didn't realize that it can fluctuate in terms of their free cash flow. So
yes,
I think we have a lot of our people asking for it. The two companies that are getting the most cloud out there, or most requests, are IBM and AMD.
Okay.
Can we do IBM?
Let's do IBM.
Great.
Okay.
So we are going an extra 30 minutes now, folks. That's incredible, Paul. I mean, you are jamming 90 minutes.
Well, the great thing is about this is we're doing more thorough analysis of each company.
A little slower.
And
I love it.
And I want people to be able to do better because of it.
Mm-hmm.
Okay. So IBM, guys, ready? Let's wait for it to go up. We all know what IBM is. I think Matt Jensen's father works for IBM.
Currently?
Paul has stamina. Thanks, Phoenix. I'm not Trader Mo. Sorry, I'm not in gym clothes. So Jensen's father, I believe, works for IBM. He can verify that. IBM's a big employer in Rochester.
Oh, Nicholas is right. Paul has been training for a wrestling event that's coming at 10,000 views. Paul and I will
10,000
wrestle.
subscribers.
10,000 subscribers. I think I'm going to tie one of my hands either to my back or to my chest to wrestle Paul. And Paul, we got to get sized up. At what point do we get sized up for our Everything money singlets. I'm certain I'm going to look.
Set it up, bro.
Okay, here we go.
All right, so IBM's worth about $100 billion, okay? PE ratio, check mark, 12.4.
Nice.
IBM's one of those old, stodgy companies, not sexy. You'll see why. Okay.
A profit margin, pillar
So
number 2.
the profit margin, first off, dividend, 6%.
Wow.
I thought about making it a pillar originally, but I don't really, I'll explain later why I don't. Profit margin here says 9.6, but if you go to the previous year, it is over 10%. I'm going to give it the check mark. And their gross profit is 48%. Beautiful. So this tells me this number right here is the quarterly, the last quarter, what they did in profit margin. But I look at the trailing 12 months, they've had over 10%. They've actually had like, over 10% profit margin. So
revenue growth over the
I'm willing to bet this is not good.
Really?
A big stodgy company like this? Yep,
Okay.
that was right.
Pillar number 3.
Guys, look at this. So this is another one. Look, I'm going to go back further. 2011, 107, 103, 98, 93, 81, 80, 79, 79, 77. So this company is, their revenue is decreasing.
No good.
Well, it's not necessarily good or bad. It's just something to look out for.
For pillar number 4, can profit be up if revenue is down, Paul?
It can be, but it would involve a lot of cost cutting. 13 down to 9.4x. Guys, these are still big numbers every year. You know what I mean? These are still big numbers every single year, but they are decreasing. So you have to factor that in there. But again, guys, if a company goes from 5 profit to 4, 3, 2, 1, it doesn't mean it's worth 0.
Now, you confuse me with this. So go through this slow.
So I will tell you guys. So
because we're talking about billions and billions and
let's
billions.
say a company makes $5 one year, $4 the next, then 3, then 2, then 1, and then it goes out of business. This is $15 in profit over the next 5 years. Does that mean it's worth 0 because it's going down? No, of course not. It's worth something. What would you pay to have it? You'd pay something to get 50. If I were to tell you right now, I'm going to give you $15 over the next 5 years, you'd be willing to pay me something for that. You'd pay me $1.
Yes.
Maybe you pay me $10. I don't know what you pay me. The point is, just because the company is decreasing its profit and revenue doesn't mean it's worth 0. It just means you have to factor in there that the business will probably be not very good at some point in the future.
Someone's asking about IBM splits. I will, I know there are some videos out there about how splits. Paul has talked about splits in the past, and typically after a split, the interest in the company goes up, and then it just goes right back down. So we've seen trends like that before. Paul, keep going. What are you looking up?
This is the number of shares outstanding. It is decreasing by about 90 million shares. So that's a check mark right there.
Pillar number 6 is assets over liabilities.
I bet you this is
assets
good.
over liabilities.
I bet you this is good. I bet you this is good. Current assets. What the?
You okay, baby?
I'm pulling up the thing now. Current assets, guys, is $40 billion. Current liabilities, $38 billion. So barely over the mark. Barely over the mark. And they have $132 billion in total debt, about $90 billion in long-term debt. That's kind of a lot for having $10 billion in profit, but we can look at that a little bit later. Now for my wonderful metric, free cash flow.
Pillar
guys,
number 7.
What I like here is it's not a big chunk. Their capital expenditures are not a big chunk of their operating cash flow, because it's operating cash flow less capital expenditures. Warren Buffett talks about he likes businesses that don't require a lot of capital to operate and keep going. So last 5 years, 13, 13, 13, 11, and 12, we'll call it, just to make it easy.
62.
62 divided by 5 equals 12.4 times 20. I wouldn't even call this 20.
Why is that?
This one I'm pivoting because it's decreasing revenue, decreasing profit. I'm actually going to go 12. So what's that? $150 billion. And what are they selling for right now? What was their market cap?
I missed it.
97. All right, guys. I think this is a possible buy.
IBM?
Yep. And here's why. Here's why.
What's going on?
You have to understand, and this I said possible buy. I made the price of free cash flow a lot lower. I sat there and said, I want to pay a very low average over the last 5 years and single digits over the last year. And this one qualifies. So I'm looking at saying, okay, IBM might be decreasing all this stuff, but is it still worth it? It might be. I'm not saying it's only a buy right now, but I think I think about $90 billion market cap. You could possibly make 12 or 13% a year on this if, even with the revenue and the profit growth decreasing every single year, as long as it decreases as long as it decreases at the same rate. If it keeps getting faster and faster, you're gonna have a problem. But this is an example of a company, their revenue is going down, their profit's going down, but they're still spitting off a lot of cash flow. If you saw their profit, their cash flow, they don't need to spend a lot of money to increase their business. They can just keep the cash flow going. And if they just keep that sustainable and keep growing at 12 billion, even if it goes from, let's say their free cash flow goes from 12 to 10 to 9 to 8, and it keeps going down, it's still worth something. And if you pay about 80 or 90 billion dollars to this, it might be a good buy. You might be able to make 15% a year, and maybe at some point in the future, people really like it. Now, before you understand that, before you do that, I want you to understand why is their revenue decreasing, and what are they doing about it to change that? Because it's a big company, and maybe they're trying to consolidate and say, we're getting rid of all of our crap businesses that we don't like, and we're going to focus on one. Because I still see a lot of IBM commercials out there.
I will say, is their dividend safe? And
their dividend is safe. Great question. The dividend right now is 6% on 95 billion. That's about 5.5, call it $6 billion. And they generate cash flows about 12 or 13 a year.
Okay,
but
slow, and then you got to pump your brakes on that. One more time, slow us down. What is that now?
Okay, so they're currently, call it $100 billion company. Their dividend is 6%.
They need
that means they're going to pay $6 billion a year in dividend.
Regardless what happens to the price.
Regardless of what happens to the price, they're going to owe $6 billion a year in dividends if they keep their dividend the same.
So they need the free cash flow.
They currently generate 12 to 13 billion a year in free cash flow. So that comes out of free cash flow. They're still going to be left with 6 or 7 billion a year in free cash flow, in extra cash flow on top of dividends. So it is safe. However, with that said, they might change their mind. If the stock keeps falling and falling and falling, and the dividend goes to 10%, they might sit there and say, guys, we're cutting the dividend in half because it's still a 5% dividend, and we're going to take the extra cash and go reinvest back in our growth and all that stuff.
Now, I was saying, what if they split into two different companies, two different stocks? What is that?
Sometimes companies will split off divisions because what their thought is, I can get more value for this company being by itself than being in one. Because maybe other parts of the company are pulling it down. That's possible. Then they'll issue you more shares, and you'll get shares of both companies, etc. So for right now, financially, the dividend is safe. The question is, will the company actually continue with the dividend, saying that if the company falls in half in price, they're not going to pay you 12%. They're going to pull the dividend back, saying, you don't need 12%. We're going to take the cash and go reinvest it, in growing our company more.
Yes, Trader Mo is saying he would swipe right. We still have people asking about IBM. Glitch Life, I see you there. We did Intel, we did Cisco and IBM in the beginning of the episode. So go back, watch the replay, and you can see that Paul loved actually all of these companies.
Phoenix just said, IBM said they're splitting its cloud and infrastructure business. Makes sense. Cloud is a very, very fast-growing industry with extremely high margins. Amazon only makes money because of their cloud business. They don't make money off selling shit. They don't make money off of Prime. They make money off of their cloud business. Microsoft's big resurgence has been because of their aggressiveness with the cloud business. It's a very, very, very high margin business.
I think we've had a lot of requests again, Paul, for AMD and Did we do Dropbox? Someone's been asking. Benjamin's been asking for Dropbox. Did we do Dropbox recently?
I don't remember that. Did we?
Let's hit AMD first because a lot of people have been asking.
Well, AMD is it's gonna be a big fat no for me. I've already looked at it. To me, I don't want to get into AMD because I think the numbers are very bad. But Intel is the clear far winner in the semiconductor industry for that one.
Oh, you want to do Dropbox? Let's
do Dropbox. That's a new one. And I want to show you guys how terrible Dropbox is. What the heck?
Oh, terrible, Paul.
Well, I mean, new companies tend to be pretty tough to. Who's
Brody K, Paul? Do you know?
I have no idea who
He's
Brody
busting Trader Mo up big time already.
Oh,
I love it. It's just funny. Okay, keep going.
By the way, Nostradante show, I agree with you. I have a concern about Dropbox being in an industry that's already pretty saturated from big players. And we've talked about Dropbox. It's cute.
Can someone, if you're in the comments, can you explain to me why Dropbox seems so archaic with their user experience?
Do you think it's archaic?
Well, first of all, it just looks like I feel like I'm on an old like Atari system. Like the way, where do I drag my files in? The sharing process is difficult compared to something like Google Drive. Google Drive is just like it just seems a little more resourceful. Dropbox, I use Dropbox. I pay them $150 a year, and my clients always have problems trying to figure out.
answer Raul's question, Dropbox is new from a publicly traded standpoint. Look at its chart here.
Go ahead, Paul.
It got as high as freaking 42. Now it's at 18. And guess what, guys? It's currently selling for $7.7 billion. And the PE ratio is 270.
Wait a minute now. Hold on a second.
So even after, I mean, it's still 270. Their profit margin is 3.7%. Now, it's probably because their gross margin is so high, but they're probably spending a ton of money to get new business. But it's already tough. But let's go through it some more.
Okay, let's do pillar.
Their revenue growth is going to be insane, I'm sure.
Revenue growth, pillar number 3.
Revenue growth. Ready, guys? It's doubled in the last 4 years. 844, 1.1, 1.4, 1.66. But it is slowing there. Now let's see if they hate making money.
Profit growth?
Yes, they hate making money.
Come on.
Now in the last 12 months, they have made money. But in the last fiscal full year, minus 210, minus 111, minus 48, 480, minus 52.
Technically,
oh yeah, you're right.
Technically
it's a check.
Of the money they're throwing out the window, they're throwing less out, Paul.
And guess what? Shares outstanding, not surprised, has gone up. X mark there.
All right, let's just stop, Paul. Your X is all over the board here.
Yeah, let's go to their cash flow. Just see that they have cash flow.
Okay.
I won't even look at the current assets because I'm sure it's more.
Go on.
Let's go to the cash flow. Man, they have decent cash flow, free cash flow, but not enough to justify it. Jesus H. Christ. Let's just go to the last year. Call it 400 million. If you believe that's a good number, that's actually 8 billion, actually, guys. Maybe it's okay. It's selling for 7.7. If you believe this growth is going to continue at really high levels, maybe it's okay. It could be not bad, but I'm going to tell you right now that it is a risk. They have a lot of competition out there that's very, very good competition. Maybe there's an acquisition. I don't know. But 20 times free cash flow last year might make sense. I don't know.
Phoenix, the people are saying they love Dropbox. Maybe write in the chat what you're in love with, and we'd certainly love to talk about it. Oh, maybe just in general, he loves Dropbox over Google Drive. I mean, both have their flaws. I agree.
Guys, they have $400 million in free cash flow. I mean, that's pretty solid. I'm not going to lie. That one is impressive to me. So you got to run this into some sort of like, the free cash flow growth is pretty good.
So Nostradamus also brought up an interesting point.
It's not Nostradamus, but it's Nostradante.
Nostradante. My apologies. He's for the forethinking. He said that Dropbox. How do they innovate? And I think that's the key. Is Dropbox for me doesn't integrate. I really love how Google Drive and or Amazon Google Drive integrates well with my email, my sharing. So Dropbox is this random sort of thing.
And this is the goal that a lot of tech companies have. They want to get you integrated in their products. Yes. That you never less likely. I actually think Dropbox is nicer than Google Drive. But Google Drive,
I'm already in Google. Like I'm living there.
Everybody knows Google
Sheets and Google. Yeah, just everything. Slides. I'm using all of it. So. There have Christmas is coming, folks. Paul wants me to dress up as Santa. So, Paul, I was looking at Santa outfits. Some are upwards of $2,000-$3,000 for the fine Santa. So, look toward Christmas. I might be dressed up. I mean, I'm definitely a Santa in the making. I got the belly, the beard, the jolly laugh. But I digress, Paul.
So, Phoenix likes Dropbox more. You think it's easier to use than Google? I actually agree with you, Phoenix. I do agree with you on that one. You know what? Like I'm changing this is why we do analysis. Like I was surprised about the 20 times free cash flow. If they can keep growing that free cash flow and keep growing the business at 20-30% clip a year, it might make sense to do it. It might make sense to have Dropbox. It's just, I worry about everybody. Microsoft, somebody mentioned Microsoft OneDrive. I've never used Microsoft OneDrive. Google's just there. So either way, I don't know if it's, me, I look at it saying, I'm going to have other opportunities for other companies that make more sense to me. And is the juice with a squeeze here? I don't know. Could it end up being okay? Sure. If they keep growing at this clip, they could end up being okay.
Let's look at TSM. What is that?
Sits in no, not that.
Sits in Laban, Paul, whatever that is. It's some sort of a meal. It's a French
TSM. Taiwan Semiconductor Manufacturing Company.
What is this? Come on.
Let's see where it's located. It's located abroad, which already we have to be concerned.
Oh, Taiwan. Yeah.
Guys, remember that our financial requirements here are a lot more strict than in other countries. It's no coincidence that whenever I look up the best free cash flow companies, they tend to be in East Asia. I personally believe, I don't know if it's true.
Go on.
It's because they're not as tight on their regulations of their publicly traded companies as we would like them to be.
You think they're fudging their numbers?
I know that a lot of them fudge their numbers. That's very well known in East Asia that there are a lot of numbers that are fudged.
Okay, you want to look at it anyway?
Yeah, we'll look at it anyhow. So to buy this company, $440 billion.
Come on.
PE ratio of 30x. Profit margin, very solid.
Of course.
39%, probably another 40% here. Now this is weird. Their gross margin is 53% and their profit margin is 39%. That means that only 15% of their money goes to operating costs.
You think they're whining, Paul? Are they whining? Okay, let's go to revenue growth, pillar number 3.
Revenue growth is not huge. 26, 29, 32, 34, 35.
Oh, Joakim says there's a whole documentary called The China Hustle about Chinese companies faking their numbers.
Really?
I would say China and
Is
Taiwan.
that on Netflix?
Probably. Okay, keep going, Paul. So the revenue is good?
Are we talking Joakim Noah?
I mean, that's what I see. But Joaquin, where are you from?
Revenue growth is a check mark, guys.
Okay.
And their net income, wow, very high. 9.5, 10.2, 11.3, 12, 11.4. Check mark there, guys.
This is pillar number 4, profit growth.
That was profit growth. Number of shares outstanding
pillar number
has
5.
Been exactly the same for 10 years. Okay, check mark.
Check, please.
That seems a little interesting.
Paul and I have 2 favorite movies. Like as friends, Paul, our 2 favorite movies are Dumb and Dumber and A Few Good Men. So whenever in the comments, if you can ever bring up those 2, you'll probably get our attention much more. Dumb and Dumber and A Few Good Men lines will certainly we'll draw our
ears. To say, look, Pa, a mailbox.
Our ears will perk up like a labradoodle. Okay, Paul, let's get
29 billion in current assets, 20 billion in current liabilities, 24 billion in total liabilities, if you believe that. So you have to decrease they have more cash on hand than all their debts combined. This is the holy grail, in my opinion, of all financials. But again, there's a still caveat of, are they being honest about it? I don't, and I'm being completely
racist.
I wouldn't say racist. I would say I am generalizing significantly based on the section of the world these guys are located. That I question their the reliability of their numbers.
Okay, how about a free cash flow? Did we just do that?
We're gonna do it right now.
Okay, here we go. Pillar number 7 of our 8-pillar system of analyzing stocks.
Free cash flow growth. Oh my gosh, this is bad.
Uh-oh.
It's not bad, but they spent a lot of money on capital expenditures. So that's 8.4, 6.4, 9. Sorry, 8, 9, 4.7.
36.5.
So that's 36.5 divided. Don't tell me 5 equals 7.17.
7.3.
7. Oh, that's right. Fudge.
You got to carry the 2, Paul. You know that.
7.3.
Okay.
Times 20, if you want to believe it, 146 billion. That is an X there. This is also an X. So 2 X's on my most important metric. 146 billion for the company. They're currently selling for 440 billion. So it's about 3 times overpriced. And an X on revenue, free cash flow, because it is not growing. So I'm glad that it's not something I have to look forward to, because even in their lies, if they are lies, it doesn't look good either way. I just called an entire continent a bunch of liars.
Continent.
I was born in Asia, by the way, but the other side, the one that goes kaboom, not the one that goes.
Joakim is from Sweden, but he's in the UK
Sweden?
now. Sweden. Okay, a lot of people.
Oh, Sweden?
Swedish. What was that?
What's that from?
Sweden. Oh, are you serious?
Yeah, what's that from?
No, I'm thinking of a different movie.
Wayne's World.
Oh, no.
Or
I'm thinking of Trading Places, brother. Okay,
I'm talking about Wayne's World 2.
Let's get into Nokia.
Drew Barrymore.
People want to know about Nokia.
Nokia. Okay, we have 7 minutes. This is the last company we're going to do, guys.
Okay, Benjamin is one of our OG followers, and he just queues up a new stock about every 5 seconds. He wants broady. I love it. So,
what is this Nokia business?
Nokia's a cell phone, Paul.
Aren't they owned by Microsoft?
You have a Nokia in your pocket right now.
No, the Nokia. We're not looking at Nokia.
You have a flip phone in your pocket.
I do. This is
what?
Okay.
Is this a stock ticker? Can someone help us? This is Nokia, the phone company?
Yeah, I guess so. It says right here, Nokia.com. I thought Nokia was owned by Microsoft. Maybe I'm thinking Motorola. I think I'm thinking Motorola.
Nokia. Oh yeah, Dave says this is it.
What's it?
He says they have some deal with NASA about building a moon service. So when we colonize the moon, Nokia will be providing us our coverage.
Sweet. Let's pick a different company.
Yes, and Trader Mo's saying this is a Space Force contract. Okay.
I'm sorry. Let's do a different company. Let's do something bigger and more exciting in the U.S.
Damn, Paul, I am tired. I'm not even talking that much.
Okay, you know what? Let's just talk about the market in general. Guys, I want you all to understand something about the market.
This. Yes, let's wrap.
The market is very frothy right now.
Oh,
okay.
Good verb.
It's expensive, and I would exhibit some caution. With that said, why did I not go to Market Watch? With that said, oh wow, stocks are up 2% today. Holy cow, I'm down a lot of money. I want you to note something here.
Earnings are today.
F you. By the way, they have Etsy. Etsy's here right now. You see, Etsy is one of the biggest losers today.
We did Etsy.
It's probably because they saw our post.
Yep.
I have eBay, and I'm buying more. I'm doing more puts on them, and they're down a lot today.
Can you blow that up a bit, Paul? Or is it possible or not really?
Yeah, I can blow it up.
Give me a second, guys. We're gonna make sure you guys can see this. There it is, Paul. Oh wow, that's
geez, OP. This is too big. Too big.
Huge.
Too big. Huge.
Huge. Okay.
Huge.
Okay, step aside there so people can see what's up.
Okay, so the market's up a lot today, guys. Yesterday it was down a lot. Today it's up a lot, making up for it. It feels like a classic October crash is on the way. Strategist warns that's all baloney. Don't listen to that stuff. Listen.
Why is that? I mean, it's a cover.
You don't know. Nobody knows when
watch.
crashes are going to happen. They just happen. That's what makes them a crash. So somebody might be able to sit there and guess it right, but they don't know. They just guessed it right. Good for them. I just sit there, and my job and your job as an investor is to say, Mr. Market says this. I either agree or I don't agree. That's it. And if crashes happen, you will probably lose money. Even if you're a value investor, your stocks will go down, but that's not the point. The point is, did you buy good stocks at good prices? And if so, the long run's what matters.
Shouldn't matter, right?
Yeah, it doesn't matter.
And with all this stocks, Paul, for our viewers is, we're 114 likes, Paul.
115.
You do advise normal people like myself to get heavily into smart ETFs that are going to give you a great return, and you'll have a nice retirement.
Well, not necessarily a great return. It's going to be you're going to match the market, and you can do other ETFs, do other trading on ETFs to generate some good returns. But what I'm trying to teach you here is how to evaluate companies. So if you choose to take 10% of your money and invest it in your own picks, that's all the more reason why you need to be picky. Warren Buffett talks about how you should have a punch card where every single time you make an investment, you're only allowed 20 investments in your life and you punch it every single time. You'd be very, very specific about. It's like getting married. You're hoping to marry one person. You don't just marry the very first person you meet and go out with. You take your time. You find the right person. You make sure it's a good. But same thing with investing. Your job is to buy 20 or 30 good companies. Pick the 20 or 30 best ones out there in terms of their relative to valuation and cash flow, in my opinion.
Is that it, Paul?
I think that's it. I know we're ending a little early, but that's what we'll do as a punishment since Seth stalled for 1 minute to get the extra time. But guys, it was a good.
Let me finish with this. This has been our most successful show ever. We have 80 people. If you told me this morning waking up that we would talk to 80 of you at one time and probably 400 or 500 in and out, it's absolutely incredible. Paul, I was down a bit the last couple of days.
Why?
Well, the show it lost a little steam. Okay, I mean, we
did not lose steam.
We've been steaming. Like
Seth saw one day we gained 71 subscribers. He wanted 71 for the rest of the time. And I'm like, Seth, that's
we
the
had
way
a
it
Cleveland
works.
steamer in January. It was just billowing smoke.
We're averaging still over 20 a day subscribers, which is way better than the guy we sat with this week in terms of ratio. He has several 100,000 subscribers. He gets about 125 a day. We're getting 20 a day with 1% of what he has. So we're good.
We will be moving toward, again, we're going to keep spoiling this to you, or at least
that's right, Nostradante. Your show is a market. It will hit low and high points. And if our low point is gaining 20 a day, I'm fine with that.
Thanks for joining us.
A month and a half ago, we were gaining 2 a day.
That's true. Thanks for joining us, guys. You guys are incredible. The gals out there as well. Keep watching. Uncle Paul will lead you in the right direction, and we'll make a gazillion dollars, Paul. What do you think?
I will lead everybody in a direction that I feel comfortable with. If it speaks to you, great. If it doesn't, there are multiple ways to skin a cat.
Love you guys.